Hello and welcome to AI Market News by LM. Right now, we are in the middle of a massive currency showdown. The US dollar is absolutely soaring, while the Japanese yen has just plunged to its lowest point in decades. So what in the world is going on, and what's next? Let's dive in. The number that everyone in the markets is watching right now is 158.54. That's how many Japanese yen it now takes to buy one single US dollar. And this isn't just a random number on a screen. It's a critical pressure point, and it's putting Japan's central bank in a really, really tough spot. So here's the puzzle we're looking at. Just as the yen is hitting these historic 34-year lows, US stock markets are rallying like there's no tomorrow. I mean, that's a massive split, right? Two major markets heading in completely opposite directions. What is causing this? Let's break it down. Okay, first up, geopolitical whiplash, market rebound. It all kicked off with a major shock to the system. Geopolitical tensions had markets on the edge of their seats. But then, the headlines took a very unexpected turn. So the first big move came from headlines about the Middle East. Word got out that the US might be delaying potential military action against Iran. And that little glimmer of de-escalation, that's all Wall Street needed to hear. And it sparked this powerful relief rally in US stocks. And boy, did the markets react. We're talking strong gains all around. The S&P 500 jumped over 1.1%, and both the Dow and the NASDAQ surged nearly 1.4%. This wasn't just a small bump, it was a serious shift in mood. But what was really lighting the fire here? It was all about oil, simple as that. As those de-escalation hopes picked up, Brent crude oil prices just, well, they tanked. At one point, they were down a wild 14%. That's one of the biggest single-day drops we've seen in years. This huge plunge in oil prices helped ease inflation fears, and that gave stocks the green light to rally hard. Okay, so geopolitics gave us that sharp, short-term turn. But the bigger, underlying story for the US dollar is all about steady, consistent pressure. And that pressure is coming from one place, the Federal Reserve. So that brings us to the big question, right? After all of that volatility and with inflation fears taking a bit of a breather, what is the market thinking the Fed's going to do next? Are rate cuts suddenly back on the menu? Well, the answer couldn't be clearer. If we look at the CME FedWatch tool, traders are placing their bets, and it's an overwhelming 91.7% probability that the Fed is going to stand pat. They are not going to change a thing. No cuts. This whole higher for longer interest rate mantra, that's the real engine behind the dollar's strength right now. All right, let's flip the script. Time to talk about the other side of this currency pair, Japan. And over there, the economic signals are, well, they're kind of confusing, to be honest. Okay, so here's the central problem for the Bank of Japan, the BOJ. On paper, it's simple. A weak currency means your imports cost more, which should push inflation up. But the actual numbers, they're telling a completely different story. Get this. Japan's core CPI for February actually dropped to 1.6%. That is below the Bank of Japan's own 2% target, and it's the first time that's happened in almost 4 years. Even the core number, which takes out food and energy, slowed down. Both of these figures missed the forecasts, which really suggests that inflation is cooling off, not firing up. But here's the crazy part. Even with that soft inflation data, the market is singing a completely different tune. We're hearing from various news commentaries that a consensus is building that these numbers shouldn't deter the BOJ from hiking next month. So why the disconnect? It's because the yen slide has just become too dramatic to ignore. Next up, BOJ under pressure. And really, this whole situation, weak inflation on one hand, but intense market pressure to hike rates on the other, has put the Bank of Japan in an unbelievably tight spot. The market is basically trying to strong-arm them into a move. And you can see that pressure coming directly from traders. Look at this. Over 63% are betting that the US dollar is going to get even stronger against the yen. That's not just a trade. It's practically a vote of no confidence. It just adds more fuel to the fire, almost daring the BOJ to do something about it. So, the stage is set for a showdown. What should we be watching for next? Well, the economic calendar has some key data points that could either throw gasoline on this fire or maybe pour some cold water on it. Yeah, looking at the upcoming schedule from investing.com, we've got to keep a close eye on the PMI data coming out of both Europe and the US. These reports, they're like a health check for the manufacturing and services sectors. If that data comes in strong, especially from the US, it could boost the dollar even more, which, you guessed it, puts even more pressure on Japan. And that leaves us with the big hanging question.
We've got the Bank of Japan totally cornered by a weak currency in a market that's demanding they act, even though their own inflation data is flashing, wait. So with this critical global data just around the corner, is something finally going to break?
This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Thanks for watching. And hey, if you found this breakdown useful, do us a favor and hit that like button and subscribe for more deep dives just like this one.